Millions of hardworking investors suffer from the anxiety of underperforming portfolios while losing their hard-earned money to exorbitant broker fees and hidden costs. Desperate for better returns, they try to find solutions by chasing hot stocks, attempting to time the market, or paying so-called financial experts who promise to beat the market but consistently fail to do so. This book reveals a shockingly simple, stress-free strategy to achieve your financial goals without ever relying on conflicted advisors. By dedicating just 90 minutes a year to low-cost smart investing, you can consistently outperform 95% of professional money managers and finally take full control of your wealth. Listen, 10 lessons from the smartest investment book you'll ever read.
It's quite the sweeping promise, isn't it?
Oh, absolutely. I mean, it sounds almost too good to be true.
Right, but as we actually deconstruct the empirical data today, you're going to see exactly how achievable that reality is for you. Because, the entire securities industry, the brokers, the analysts, the financial media, is basically built on this pervasive illusion. They desperately need you to feel like the markets are just, well, too complex, right? Too fast and opaque for you to navigate without their highly compensated intervention. So the mission for today's deep dive is to shatter that illusion using just cold, hard math.
I love that. Welcome to the Deep Dive, everyone. We are super thrilled to have you with us as we unpack Daniel R. Solin's rigorous data-driven framework. And we're not just going to summarize his points here. We are really going to look under the hood at the actual mechanics of why the traditional financial advisory model is, well, mathematically rigged against you, and exactly how you can bypass it.
Exactly.
So let's establish the foundational problem right out of the gate. Lesson 1. The myth of the experts brokers can't beat the market. We have this, culturally ingrained image of Wall Street analysts, right?
Yeah, the guys in the nice suits.
Yeah, supercomputers humming, brilliant minds, finding inefficiencies, executing the perfect trade.
And that image is a totally manufactured marketing triumph. It's brilliant marketing, honestly. The traditional financial consulting industry relies heavily on what Seppian calls hyperactive management.
Right.
It's this premise that these highly paid managers possess a unique, repeatable ability to pick anomalous winning stocks,
Yeah.
and accurately time market corrections.
But the data says otherwise.
Entirely. When you examine the peer-reviewed evidence, long-term, consistent outperformance by active managers is statistically indistinguishable from pure chance.
Wow, pure chance.
Yeah, it's not an information advantage at all. It's just a probability distribution.
Okay, let's unpack this, because there is this training anecdote in the source material that just perfectly illustrates this illusion of expertise, and it blew my mind. So Lachlan details how rookie brokers actually build their client books when they're starting out.
Oh, the coin flip strategy.
Yes, it is a literal coin flip shell game. So they take a list of 120 leads, they call 60 people and confidently predict a specific stock will go up. Then they call the other 60 and predict that exact same stock will go down.
Which is, a completely risk-free bet for the broker.
Right, because one of them has to be true. So a few weeks later, the stock moves. They completely discard the 60 people they were wrong about, don't call them again. They take the 60 people they were right about and split them again. 30 get a buy prediction, 30 get a sell. And after doing this 3 consecutive times, they have this distilled list of 15 people who have just watched this broker make 3 flawlessly accurate market calls in a row.
It's wild.
Those 15 people are utterly convinced they have found a market savant, right? And they eagerly hand over their entire portfolios.
Yeah, it's a phenomenal demonstration of survivorship bias used as a deliberate sales tactic. Because the broker didn't actually predict anything, right? They just manipulated probability to create an illusion of foresight.
Just flipping coins in a nice suit.
Exactly. Which naturally leads us to the core thesis here. If active management is basically just a theatrical performance designed to harvest your client assets, how should you actually be deploying your capital?
Which brings us directly to the alternative. Lesson 2. Smart investing means low-cost ETFs. Now, I know our audience generally knows what an exchange-traded fund is, right? A basket of securities tracking a broader index like the S&P 500.
Sure.
But what the source data highlights isn't just the structural mechanics of an ETF, it's the sheer mathematical efficiency of its underlying cost basis compared to, well, the massive frictional drag of active management.
Precisely. And this is what we call smart investing. It's not about paying someone to find the needle in the haystack. It's the deliberate, calculated decision to just buy the entire haystack.
Just buy the haystack. I love that analogy. Instead of paying someone a fortune to find the needle, you own the whole thing.
Right, because by holding the broader index, you are efficiently capturing the natural, historical upward drift of global equities, but without incurring the massive frictional costs of constant trading. And what's fascinating here is that this is exactly how institutional smart money actually operates. The multi-billion-dollar pension funds, university endowments, they do not rely on hyperactive stock picking for their core holdings.
They don't have guys trying to pick the next hot tech stock.
No. They use broad index funds because the math of capturing market return at a basis point cost is just undeniable.
Okay, the efficiency makes sense, but I have to push back here on behalf of our listeners. Let's move to lesson 3. Fees are the ultimate enemy of wealth. I hear you on the math of buying the haystack, but let's play devil's advocate for a second.
Okay, go ahead.
So, what does this all mean? In normal life, paying more gets you better quality. A more expensive car is usually a better car. Shouldn't a high-fee fund be better? If I'm looking at a looming recession, having a human being at the helm who can tactically move my assets to cash seems vastly superior to an ETF that's just, forced by its mandate to ride the market all the way down to the bottom.
Yeah, that's the argument they always use.
Right. So why shouldn't I pay a 2% management expense ratio for that active downside protection?
Well, because that is the exact psychological comfort that active managers sell. But the data absolutely destroys that premise.
Really? Destroyed?
Yes. The reality is that human managers are notoriously terrible at timing the bottom. Sure, a mutual fund manager might move to cash during a panic, and maybe that dampens the fall slightly on the way down.
Okay.
But the mechanism that actually hurts you is what happens next. They inevitably hold that cash too long. They're paralyzed by the exact same human fear as everyone else, right? So they completely miss the massive rapid days of recovery that follow a crash.
Oh, wow.
And missing just the 10 best trading days in a decade can literally have your total return. The passive ETF, by remaining fully invested the whole time, captures 100% of that rebound.
That makes a lot of sense. So let's look at the compounding deficit here. So Gallon points out the terrifying reality of the Canadian market in the text, for example. The average active mutual fund charges a 2.4% ER, sometimes with a 4% front-end load just to buy in.
It's robbery.
Meanwhile, a broad ETF costs what, maybe 0.15%? Or even less?
Yeah, some are under 0.05% now. If we connect this to the bigger picture, investing is basically the only industry on earth where you reliably get what you don't pay for.
Wait, say that again?
You get what you don't pay for. If you have a $100,000 portfolio, a 2% fee differential means you are hemorrhaging $2,000 every single year.
Right off the top.
Right off the top, regardless of whether the fund actually goes up or down.
Okay.
That manager doesn't just have to beat the market. They have to beat the market by more than 2% annually just for you to break even with the passive ETF.
That's a huge hurdle. Over a 20-year investing horizon, that fee drag compounding against you can consume hundreds of thousands of dollars of your potential wealth.
Exactly. It's devastating.
So if stock picking and market timing are just these statistical dead ends that rack up fees, what actually determines whether our portfolios grow or stagnate?
That is the right question.
Let's get into it. Lesson 4. Asset allocation trumps stock picking. This is where we shift from what we shouldn't do to the core mechanism of what actually works.
Yeah, and this is backed by some of the most robust academic research in finance, particularly the landmark Brinson, Singer, and Biebauer study.
Right, the famous one.
Exactly. They analyzed massive pension funds and found this startling reality. Over 90% of a portfolio's return variability is dictated entirely by asset allocation.
90%.
Over 90%. That means the macro-level decision of how you divide your capital between broad asset classes, equities, fixed income bonds, and cash equivalents.
And the actual individual stocks you pick account for only about 5% of the variance. And trying to time the market is a measly 2%.
Yep.
It's like baking a cake. Asset allocation is the flour, the sugar, the eggs. It dictates the fundamental core structure of the cake. Stock picking is just deciding what color sprinkles to put on top. And brokers are basically charging you a fortune just to passionately debate sprinkle colors.
That analogy perfectly illustrates the absurdity of it, honestly. You're paying 2% a year for sprinkles while they ignore the cake. And the mechanism behind why asset allocation drives 90% of returns really comes down to correlation. Well, equities and high-quality bonds generally have low or even negative correlation. When the stock market faces a severe contraction, capital tends to flee toward the safety of bonds, which stabilizes that portion of your portfolio.
Okay.
The source text highlights this 29-year study showing this exact dynamic. A conservative 100% intermediate-term bond portfolio yielded a 9.3% annualized return, and its absolute worst 12-month period was a mere 4.5% drop.
Very safe.
Right. Conversely, a 100% equity portfolio yielded 11.7% higher return, yes, but you had to endure a worse 12-month plunge of over 15.1%. So your asset allocation is really the primary dial you turn to mathematically control your exposure to volatility.
Okay, so if the underlying reality is that asset allocation is the core structure, the only dial that truly matters, why is the daily financial news screaming at us to trade on every single headline?
Well, that's a whole different industry.
Right. Lesson 5, ignore financial pornography. The term alone is incredibly evocative.
It is. It was coined by the brilliant economic journalist Jane Bryant Quinn, and it diagnoses exactly what the financial media complex is actually doing.
Which is what?
Well, the breathless cable news alerts, the dramatic magazine covers, the constant stream of macroeconomic predictions, none of this is engineered to optimize your portfolio. It's engineered to capture your attention, sell advertising, and generate network revenue.
Right. It's entertainment.
Yes. And they do that by manipulating your deeply ingrained psychological biases, specifically loss aversion and greed.
Here's where it gets really interesting, because Solin points to a classic example that proves how toxic this noise actually is. Back in July 1993, Forbes magazine ran this highly publicized cover featuring a prominent Wall Street strategist, Barton Biggs, and they literally had him dressed in a full bear suit.
A literal bear suit on the cover of Forbes.
Yes, and the accompanying article emphatically urged investors to dump all their U.S. equities immediately and pivot heavily into emerging markets.
And if an investor had actually acted on that highly authoritative, dramatically presented advice,
it would have been an unmitigated disaster, a catastrophic destruction of wealth. Because emerging markets plunged over the following 3 years while the U.S. market enjoyed a massive, sustained rally. If you let the guy in the bear suit dictate your asset allocation, you actively sabotaged your own financial future.
which underscores a really vital truth here. Financial pundits possess no proprietary view of the macroeconomic future. None.
Right.
They simply excel at constructing compelling, anxiety-inducing narratives. They enforce this false premise that short-term geopolitical or economic events require immediate, hyperactive adjustments to your portfolio.
And when investors are vibrating with that media-induced anxiety, they naturally look for an easy shortcut to safety, right? They look for authoritative badges of approval to tell them what to do. Which leads perfectly into our next point. Lesson 6. Stop chasing hot funds and star ratings.
Yes, the star ratings.
For decades, the gold standard for retail investors has been Morningstar's 5-star rating system. I mean, surely a 5-star rating means the fund is a safe bet, right?
It feels incredibly logical. If an independent analytical firm awards a mutual fund 5 stars, it must inherently be a mathematically superior vehicle for my capital.
Yeah, that's what everyone thinks.
But the empirical data proves it is a complete behavioral trap. Exhaustive analysis of the Morningstar rating system reveals a critical flaw. 5-star ratings have almost zero predictive power regarding future outperformance.
Zero predictive power.
Pretty much. Because they're looking entirely in the rearview mirror. This requires understanding the mechanism of mean reversion. To earn 5 stars in the first place, a mutual fund manager typically had to make highly concentrated, aggressive bets on specific sectors that just happened to perfectly align with the recent macroeconomic cycle.
So they took outsized risks, and they essentially got lucky in the short term.
Precisely. They guessed right on the sprinkle colors. But markets are cyclical. By the time that fund achieves its 5-star rating and retail investors start pouring all their money in, the economic cycle is already shifting.
Ah, I see where this is going.
The exact concentrated risks that generated the outperformance are statistically highly probable to underperform in the next cycle. This is mean reversion. The fund drops back down to a 3-star or 2-star rating.
And Morningstar themselves have explicitly warned that their ratings are backward-looking historical summaries, not forward-looking predictive models. Yet, brokers constantly use these stars as their primary mechanism to sell expensive funds to unsuspecting clients.
Constantly.
And the devastating secondary effect of this is what the industry calls the churn. Retail investors buy the five-star fund after the growth has already happened. The fund invariably mean reverts and underperforms.
Right.
So the investor panics, sells the fund at a loss, and immediately buys whatever the new hot five-star fund is. Because of this constant performance chasing, data shows the average mutual fund investor holds a fund for only about 4 years.
It's tragic, honestly. They are trapped in a perpetual cycle of buying high and selling low.
Which is the perfect segue to understanding the physical cost of that behavior. Lesson 7. The activity myth trading is hazardous to your wealth. Why does the brokerage industry actively encourage this constant jumping around?
Because in the ecosystem of retail finance, your activity is not progress. Your activity is pure revenue for the broker.
That's the dirty secret.
It is. Academic consensus is unequivocal on this. There is an inverse correlation between trading frequency and net portfolio returns. The more you trade, the more you underperform a static buy and hold index.
Because every single transaction carries frictional drag, makes you feel like you are actively managing your wealth, but you're really just actively draining your account.
Exactly.
And it's not just the explicit commission fees, although those obviously exist. It's the bid-ask spreads every time you enter or exit a position. It's the realization of short-term capital gains taxes that instantly carve 20 or 30% off your profit before it can even begin to compound.
Yes. The tax drag is huge. The broker calls you, sounding incredibly proactive, suggesting you sell your underperforming dogs, right, and rotate into a new, exciting sector.
Making you feel special.
Yeah. It creates the illusion that your wealth is being actively defended by a professional. But mechanically, every rotation bleeds capital out of your portfolio and transfers it directly to the brokerage firm's balance sheet via transaction costs. They need you addicted to the adrenaline of trading.
Because a static, perfectly balanced ETF portfolio generates almost zero transactional revenue for them.
Exactly. They starve if you sit still.
And by keeping you focused on the excitement of trading and chasing returns, brokers conveniently distract you from the most vital concept in investing. Lesson 8. Understand true risk, not just reward. When a broker pitches a new, exciting fund, the presentation is always heavily weighted toward historical upside.
But look at these returns.
Exactly. They point to an annualized 12% return and ask what you plan to do with all your future wealth, but they rarely, if ever, discuss standard deviation or true risk.
And this raises an important question. Why does the industry avoid talking about standard deviation? Because true risk isn't just standard volatility. It is the behavioral breakdown that volatility triggers in the investor.
Okay, unpack that.
If you're assessing a portfolio, the most critical metric you need to understand is its worst 12-month historical loss. How far can this specific asset allocation mathematically drop during a severe recession?
But wait, if I'm investing for the long term, like 20 or 30 years, why should I care about a temporary 12-month volatility drawdown? Shouldn't I just focus on the highest possible return and just ignore the dips?
Theoretically, yes, if you were a robot. But behaviorally, it is nearly impossible for a human being. If you don't understand your worst 12-month loss potential, you are completely unprepared for the psychological terror of watching, say, 40% of your net worth just evaporate in a 6-month bear market.
Yep.
That is when human psychology overrides rational planning. You panic. You capitulate and sell your assets at absolute rock-bottom prices just to stop the pain. And by doing that, you turn a temporary paper drawdown into a permanent catastrophic loss of capital.
Wow.
Smart investors mathematically measure risk and determine their tolerance analytically before the crash happens, utilizing bonds to dampen the standard deviation to a level where they can actually sleep at night.
Right. They avoid the panic selling. And ignoring this true measure of risk is exactly what makes investors susceptible to the most dangerous, alluring pitches the financial industry has to offer. Which brings us to Lesson 9. Beware of toxic, get-rich-quick investments.
Yes, the toxic traps.
Once you step outside the protective walls of broad asset allocation, the financial industry just has an array of incredibly dangerous products designed to extract your wealth. Let's look at the elite world of hedge funds.
Oh, hedge funds. They are marketed brilliantly, honestly. They utilize astronomically high minimum investments and complex strategies to create this aura of exclusivity. They make retail investors feel like they're finally getting access to the secret strategies of the ultra-rich.
The VIP room.
Yeah. But the mathematical reality is that hedge funds operate on a notoriously predatory fee structure, usually what they call 2 and 20. They take 2% of your total assets under management every single year just for existing, plus 20% of all profits generated.
And the asymmetry there is just wild to me. If the fund manager takes huge speculative risks and hits a home run, they take 20% of your upside.
Right.
But if they take those exact same risks and blow up the fund, losing half your money, they don't refund you 20% of the losses. They still charge you the 2% base fee on whatever capital you have left.
It's an incredible deal for the manager. It's no wonder Forbes published an article calling the hedge fund space amateur hour, heavily populated by charlatans. The risk is entirely asymmetric against the investor.
And it's not just hedge funds. Margin and sector betting are just as bad. When you utilize margin, basically borrowing money from your brokerage to invest, it acts like gasoline on a financial fire.
Yeah, it introduces the risk of a margin call. If the market drops rapidly, your broker can unilaterally liquidate your holdings at the absolute bottom just to cover their loan.
Yeah.
It is the financial equivalent of juggling lit dynamite.
And sector betting. Betting all your money on one sector, like just biotech or just value stocks.
That abandons the mathematical safety of broad diversification entirely. It replaces empirical investing with rank speculation. You're just gambling at that point.
So we have dismantled the illusions. We know that active management is basically a statistical coin flip. We know fees and taxes are the silent killers of wealth. We know the media is selling anxiety and that ratings and complex hedge funds are just toxic behavioral traps.
One cleared it all away.
Right. So what is the actual practical roadmap to do this right? Lesson 10, the ultimate 4-step smart investor process. The brilliance of Solin's methodology is that it distills decades of empirical financial research into 4 shockingly simple, actionable steps.
It really is simple. Step 1 is deciding your asset allocation. This is where you build the foundation of the cake.
Yeah.
And you don't just use generic, outdated rules of thumb like subtract your age from 100.
Right, don't do that.
No, you utilize a rigorous risk assessment questionnaire to determine your actual personal psychological tolerance for drawdowns. This dictates your foundational ratio. For instance, maybe you land on 60% equities to capture growth and 40% fixed income bonds to dampen the volatility.
Okay, so you have your target mix. Step 2 is opening a brokerage account. And this means using a deep discount or zero commission online broker, paying strict attention to transaction fees, and completely severing the cord with high-fee advisory firms.
Exactly. Cut out the middleman. Then step 3 is select your investments. You populate that 60-40 allocation strictly using broad market, low-cost, exchange-traded funds.
You buy the entire global haystack.
Yes. You capture the inherent growth of domestic and international equities, and you utilize highly rated, broad bond index funds for your fixed income. No individual stock picking, no trying to guess the next hot sector.
And finally, step 4, rebalance. This is the maintenance phase, and it is the most elegant mechanism in the entire strategy. But how exactly does this work mechanically?
Let's say you start with that target of 60% stocks and 40% bonds. And then the stock market goes on an incredible 2-year bull run.
Stocks go way up.
Right. Because your equities grew so fast, your portfolio naturally drifts out of alignment. Let's say it's now sitting at 75% stocks and 25% bonds. You are now exposed to significantly more risk than your profile actually allows.
Oh, okay, I see.
So to rebalance, you mathematically force yourself to sell off that excess 15% of your outperforming equities, and you use that cash to buy more of your underperforming bonds, restoring that 60-40 equilibrium.
Wow. So you are systematically locking in your equity gains and buying bonds while they're relatively cheap. It mechanically forces you to do exactly what active managers constantly fail to do, buy low and sell high.
Yes, it entirely removes human emotion from the equation.
And the absolute best part of this entire framework. Once those 4 steps are implemented and set up, your total time commitment for that annual rebalancing is less than 90 minutes a year.
That's the real magic. To synthesize the empirical reality we've explored today, the multi-trillion-dollar financial complex desperately wants you confused. They rely on your hyperactivity, your anxiety, and your willingness to bleed capital through exorbitant fees.
They need you on the hamster wheel.
Exactly.
Yeah.
But by stepping off that manufactured hamster wheel and embracing the mathematical superiority of low-cost, broadly diversified index capture, you don't just stop the bleeding. You mathematically guarantee higher long-term returns than the vast majority of highly compensated professionals.
You stop subsidizing Wall Street's bonuses and start compounding your own capital. And that brings us to our final thought for you to ponder today. What if the ultimate luxury of building true wealth isn't about bragging at a dinner party that you successfully timed a hot tech stock? What if true wealth is reclaiming the countless hours and the exhausting, low-level mental energy you used to spend worrying about financial pornography and agonizing over your portfolio? When you automate your success through smart investing, you aren't just buying better returns, you are buying back your time.
Absolutely.
Thank you for watching. Please like, share, subscribe, follow up in the next video.